The dangerous stagflation scenario might be repeating. When economies are hit by multiple conflicting shocks, forecasting becomes nearly impossible, and that's exactly what's happening now. Today's inflation path looks eerily similar to the 1970s, when inflation cooled, only to surge again in a second, more painful wave. After the post-pandemic peak, inflation has come down. But the forecast suggests another climb is coming. If that plays out, we'll be dealing with the worst-case scenario. Inflation accelerating again just as growth slows. That's the definition of stagflation, and it's a situation no one is prepared for. Meanwhile, a serious disconnect has opened up between the US dollar and 10-year Treasury yields. These two typically move together. Higher yields, stronger dollar. But since the start of the trade war, that relationship has broken. Yields remain elevated, suggesting persistent inflation risk, but the dollar has weakened sharply. That tells us investors are losing faith in the dollar as a safe haven, even as inflation stays sticky. This kind of divergence is rare, and when it happens, it often precedes deeper instability across markets. Oil's behavior only adds to the confusion. Unlike the S&P 500, which bounced back in typical V-shaped fashion after recent shocks, crude oil has stayed flat, even as geopolitical risks mount. And more unusually, the drop in oil prices hasn't translated into falling inflation expectations. Normally, inflation break-evens fall when oil falls. But now the link is broken. This suggests that either investors believe the oil dip is temporary, or that inflation is being driven by other forces entirely: wages, tariffs, supply chains. Either way, the market is behaving differently than before, and that signals uncertainty about what's really driving inflation. So the question is, are we dealing with a real recession or just a slowdown? Unlike the Lehman collapse or the COVID shock, today's economy isn't falling off a cliff, it's grinding down slowly. GDP hasn't plunged for 2 straight quarters, but the signs of stress are everywhere. Tighter trade conditions, credit downgrades, a weakening dollar, and now higher joblessness. The textbook recession might not be here yet, but the economy is clearly under pressure, and we may not be far from the tipping point. Tariffs have played a central role in this. Since the April tariff escalation, import costs have jumped dramatically, from 3% to 18%, pushing prices up across the board. That alone has added 1.7% to short-term inflation. But growth is also taking a hit. Real GDP has already slipped 0.7% this year, and the labor market is showing signs of stress. Nearly 500,000 jobs lost, and unemployment edging up by 0.4 percentage points. The slowdown isn't theoretical. It's already showing up in data. When you plot inflation and growth together, the risk becomes obvious. If both are strong, it's manageable, even bullish. If both are weak, that's recession. But the most dangerous quadrant is where inflation stays high while growth falls. That's stagflation. Central banks can't stimulate because inflation's too hot, and markets struggle because growth is too slow. That's where we might be headed, and it explains why the Fed is in such a bind. The mechanics behind it are familiar. Lower rates boost growth and inflation. Higher rates cool both. But the challenge now is timing. The Fed held rates high to crush inflation, but now it faces rising unemployment and slowing growth, while inflation still lingers. The danger is clear. Cut rates too late, and the labor market breaks. Cut too early, and inflation reignites. The balance is fragile, and the stakes are high. Markets know it. That's why every disconnect, every divergence matters. This brings us to our favorite recession indicator: unemployment and interest rates moving in a specific pattern together. Every major recession, the dot-com crash, the 2008 financial crisis, and the 2020 COVID collapse, was followed by a clear spike in joblessness. It's a classic pattern, and we even believe this might be a better signal than the famous yield curve indicator. When you compare them, you see a near-perfect inverse correlation. Rates rise, unemployment stays low. Then, as rates begin to fall, unemployment starts to climb. It's counterintuitive because we're taught that lower rates stimulate hiring. But in reality, rate cuts don't lead recoveries. They follow weakness. There's a misconception that monetary easing kickstarts the economy. In truth, it's usually a reaction to stress that's already building. And that stress often shows up next in the labor market. That's exactly what we're seeing now. Rates have started drifting down from their peak, while unemployment is ticking up toward 4.1%. History suggests this is just the beginning. The Fed isn't cutting because the labor market is strong. It's cutting because it's turning. And if the past 2 decades are any guide, that path tends to run its full course. We've seen this before. In 2020, the Fed slashed rates to zero amid full-blown panic, and M2 money supply exploded as liquidity flooded the system. But what stands out even more is the rhythm. From 2000 to 2025, rate cycles have moved in clean, monotonic arcs, up to 5%, then all the way back down. And unemployment, though slower to react, has followed each time. The GFC left deep scars, requiring a nearly decade-long recovery. The COVID spike, though sharper, bounced back faster. The pattern now appears to be repeating. Only this time, we're just on the front end of that curve. As always, this is not financial advice or a recommendation to buy or sell. We provide you with our view and take on macro analysis with regard to the markets. Thanks for watching. This is Glennius.